15%. I mean, just let that sink in for a second. After this absolutely face-ripping 160% rally, the price of silver just collapses, 15% in a single day. You know, for anybody using leverage, that was a total wipeout event. We're talking entire accounts just gone, vaporized. But then, the very next day, it roars back 10%. Now, this isn't normal market behavior. This is pure chaos. And believe it or not, it's the key to understanding a much, much bigger story.
What we're all witnessing right now, it isn't just random volatility. It's a battle, a really high-stakes conflict where the immense power of the paper financial markets is crashing head-on into the undeniable reality of a physical commodity shortage. You've got these two titanic forces pulling the market in completely opposite directions, and, well, understanding this war is really the only way to navigate what's coming next. Welcome to the Silver Signal. Our whole mission here is to help you separate what truly matters, the signal, from all the distracting noise out there in the financial world. We're really glad to have you with us, by the way. You're joining a rapidly growing community of informed viewers who are committed to understanding these complex forces. So, if you find value in this analysis, go ahead and subscribe so you'll be notified of our future updates.
Okay, let's dive right into this. The stage was set back in early 2025. Silver went on one of the most incredible runs I have ever seen, just exploding from around $30 an ounce to over $80. Now, this wasn't just speculation. No, it was fueled by desperate industrial demand running smack into a severe lack of physical metal. But right as that rocket seemed absolutely unstoppable, an outside force intervened, and everything spiraled.
So here's the central conflict. On one side, you've got the physical reality. Industries are screaming for metal. Visible stockpiles are draining to really critical levels, and demand is just relentless. But on the other side, you've got the paper market, where prices are taking these gut-wrenching dives that seem to defy all logic. This contradiction, this is the battlefield we're going to analyze right now.
So, what's causing this? I mean, this is not the invisible hand of the market at work. There is a very, very visible hand here, a powerful institution that has decided to step right into the ring and, change the rules in the middle of the fight. And that visible hand? It belongs to the CME Group, which runs the world's largest futures exchange.
Now, to really get what's happening, you have to understand the weapon they're using. And it's not some obscure financial jargon, it's the core mechanism at the center of this whole story, futures margins. This is how an exchange can, literally, with the stroke of a pen, completely change the market landscape and force the hands of thousands of traders. It's their financial sledgehammer.
So, what is a margin exactly? Well, think of it like a good faith deposit. It's not the full price of the silver, it's just the collateral you have to put up to open and hold a futures position. Its official purpose is to protect the market from people defaulting, but its secondary effect is way more powerful. It's the key that unlocks financial leverage, and that allows traders to control a huge amount of silver with a pretty small amount of capital.
And here's how the CME turns this tool into a weapon. See, when margins are low, your leverage is high. A little bit of cash controls a very large position, which magnifies your potential profits and your losses. But when the CME hikes that margin requirement, they completely flip the equation. All of a sudden, you need way more cash to hold the exact same position.
This shows you the chain reaction perfectly. The CME hikes margins. Traders who are leveraged long get hit with an immediate capital call. That means they have to deposit more money right now. A lot of them can't, so they are forced to liquidate by selling their contracts. And when thousands of traders are forced to sell for the same reason at the same time, well, the price really has nowhere to go but down. It's an orchestrated liquidation. Now let's look at how this all played out in real time. The last week of December 2025 was, well, it was truly unprecedented. The CME Group didn't just nudge the market, they took that sledgehammer to it. The timeline of what happened tells a story of speed and aggression, and it reveals a level of concern inside the exchange that we just haven't seen in many, many years.
So here's the play-by-play. On December 26th, they announced the first hike, 13.6%, which took effect on the 29th. The effect was immediate. But before the market could even catch its breath, they announced a second,
much larger hike of 30% on December 30th, set to take effect after the new year. This rapid-fire attack was a crystal-clear signal. The exchange was determined to stop this rally in its track. And the result of that first hike was a straight-up flash crash. Silver just plunged from over $82 down to about $73.70. It was a brutal move that vaporized billions in leveraged long positions. A brutally efficient flush of speculative money. But what happened next was so crucial. The price didn't stay down. It rebounded sharply. And that was a huge signal that the underlying physical demand was still incredibly strong. That second hike was even bigger, and it wasn't just aimed at silver. No, they raised margins across the entire precious metals complex. 25% for platinum, 22% for palladium, even 9% for gold. This was a coordinated, system-wide move designed to crush bullish sentiment everywhere. But let's make no mistake about it. With a massive 30% hike, silver was clearly the number one target. So this brings us to a really crucial question, and I'd be interested to read what you think in the comments. Is this simply prudent risk management like the exchange claims it is? Or is it a more deliberate intervention designed to protect large institutions who got caught on the wrong side of the trade? What do you think is the primary motivation here? All right, this is where the story pivots from the paper markets to the hard reality of the physical world. See, you can play all the games you want with futures contracts, but those paper tricks, they cannot create a single new ounce of physical silver. And that is the core, unsolvable problem the exchange is up against. This rally is built on a genuine physical shortage. And this is why the physical market is so resilient. A full 50% of all silver demand comes from industrial use. We're not talking about coins or bars sitting in a vault. We're talking about essential, absolutely irreplaceable components for solar panels, electric vehicles, 5G tech, you name it. This is sticky, non-negotiable demand. Industries have to have it, and that demand doesn't care one bit about margin hikes on a futures exchange. So we're left with two completely different stories, right? The official CME narrative is risk management. They say they see volatility and they act to protect the financial system. That's their job. But the physical market reality suggests something else entirely. Critics argue these actions are basically a lifeline for large banks who are caught in massive short positions and were getting squeezed hard by the rising price. And the evidence for a physical squeeze just keeps piling up. China is putting in export curbs that are going to slash global supply. Vault inventories in New York and London are being drained at an alarming rate. We're even seeing a market condition called backwardation. That's a huge signal of an immediate shortage. It basically means the price for silver delivered today is higher than the price for silver delivered in the future. Industries are willing to pay a premium to get the metal right now. Now, it's really tempting to see this as some kind of unique, once-in-a-lifetime event, but it isn't. The playbook of using margin hikes to smash a runaway silver rally is actually pretty well worn, and looking at history gives us a valuable roadmap for what's likely to happen next, because in these markets, history doesn't just rhyme, it often repeats with stunning accuracy. The most famous example, of course, is 1980, when the Hunt brothers tried to corner the silver market. The exchange fought back with these massive targeted margin hikes. This led directly to the infamous Silver Thursday crash, and it established the precedent that yes, the exchange would change the rules to break a rally. And more recently, back in 2011, as silver was screaming towards $50 an ounce, the CME unleashed 5 separate margin hikes in just 9 trading days. The effect was devastating in the short term. It crashed the price by 50%. What we're seeing today with 2 huge hikes in a single week is a direct echo of that 2011 playbook. So here's the crucial point. History shows us that in the short term, these hikes work. They absolutely do. They break the fever, they crush momentum, and they send prices tumbling. But, and this is a big but, they do not solve the underlying fundamental reasons for the rally. After the leveraged traders are flushed out, the physical market fundamentals eventually take over again. And historically, these intervention-driven dips have proven to be incredible buying opportunities. And this brings us to what might be the most important takeaway for today. The actions taken by the CME, they shouldn't be seen as a sign of strength or confident control. They should be seen for what they really are, a sign of pure desperation. It's a frantic attempt to keep the lid on a pot that is absolutely boiling over. They're fighting the paper battle, but it really looks like they are losing the physical war.
They can win the battle on any given day, sure, by flushing out paper traders. But what they cannot do is print physical silver. The physical reality is diverging sharply from the paper price, and it's no longer a question of if reality will bite back, but when. And that's where we'll conclude part 1 of our analysis. Join us for part 2, where we'll reveal the hidden signal in all this noise and outline a strategic framework for navigating this historic conflict. We'll see you next time.